Good evening. This is Doc Severson for the Theo Night Report for Tuesday, October 3rd. We'll start out tonight with the S&P 500 cash index. And like I talked about last Thursday when I said that, look, you know, this market should, by all rights, be correcting at some point. But I've been saying that for the last 6 months. And frankly, I'm tired of being the boy that cried wolf on this thing. So when we have this level of energy, and we have these objective signals here basically saying that based on the trend that we have, this should break out. And we certainly have seen that really since Friday. We've seen this thing breaking out to the upside now. Be careful, because now we're approaching exhaustion again. So this is how this market is moving and has been moving for some time, is that, yes, it does have these concrete overshoes here on the monthly chart, which is going to prevent any breakout from really realizing much of its potential. But we're going to continue just stair-stepping from these levels. Breakout, consolidation, breakout, next consolidation, whenever that comes, probably fairly soon. And this pattern will continue at some point until we do get what I call the shot that comes over the bow, which is going to be a fairly big red candle, which will just show up and kind of announce the fact that volatility has taken over. That will not necessarily be the initial low. We could bounce back up, and then the initial low will be set after that. That's usually what happens when we drive that lower high that sets up on the weekly chart. And what I'm thinking is that whenever that does show up, we'll just end up printing a larger range here. Again, I'm not calling for a crash on this thing, even though so many people are calling for a crash on the financial pages. Usually when you see so many people publishing predictions for a crash in the financial pundits out there, usually that's when markets continue going higher. Now, the real star lately has been the Russell 2000, just a staggering move here of well over 150 points on the Russell. This is very unusual, but as you can see, we've done this before. We did this back after the election, and it got down into this massive level of exhaustion. This is why the Russell always earns a higher implied volatility, because this sort of thing can happen in both directions. Now, in tandem with this has come the transports. The transports have broken out, and this really leads me to kind of my setup of the day, which has been Delta Airlines. So Delta Airlines was one of the stocks that we called out in the room today that we said, hey, this one's breaking out. And I love how this sets up, because this goes right into one of the setups that I've been teaching lately, which is called the trap, or the trap trade. Okay, so what happens with this is that we have an established downtrend in play, and all of the airlines certainly had an established downtrend in play here. Lower highs, lower lows, lower highs, barely lower low. And then what we saw from here was, as we got into early September, was we saw a breakout from here. Now that's the first signal. That's the first possible trap signal that's out there. From here, we saw consolidation building up the energy again. And here's the second signal, the break above this zone. Great big move today. So this is exactly the sort of trade that we want to see, and basically what we can do is a couple of different things. Either we just take ourselves into the trade, or the easier thing to do many times is just simply to determine where that range is on the trade, and then just create an alert. Right click and create an alert on there and tell yourself what to do should the price break above there. You'll be emailed in terms of when that does happen. And many times you'll forget about even putting this alert on. But this is key towards capturing the value from these excellent setups that will occur, because the shelf life on these things, the half-life on these, is pretty quick. I mean, we saw this early on this morning, and it had already broken out 2 points above our entry point by the time this thing got really going. Now, the best way that we know of to trade these is through a vertical spread known as an in-out spread. So one option in the money, another option out of the money. What we're looking for is pretty much unity. So if we have a $1 wide spread like this one, what we're looking for is to pay about 50 cents for that. And what this does is that this neutralizes all of the Greeks on here that are really against what we're trying to do. So it neutralizes the time value decay on the spread, which is bad if you're in a directional trade. What it also does is neutralizes the vega for the trade. So the sensitivity to changes in implied volatility. If you do have a breakout to the upside, many times that will crush the life out of something like a long call option. If you just take long calls on here, not only do you have the time value decay to deal with, but also the implied volatility crush on any breakout to the upside. So if you're able to, and sometimes we're not always able to do this with this type of trade just because of the volatility skew that we've had to deal with, but this is by far the best type of setup to use on trades like this, is to look for that in-out spread, set them up with perhaps anywhere from 2 weeks to 4 weeks of time value, and then set a relatively conservative trade setup, which makes it worth it for these, which is usually 50 to 60% or so as far as the return on capital. They're very easy to manage, and we've defined our risk from day one on here. We don't have to lose sleep at night wondering whether or not the price is going to run over our strikes or anything like that, which is always the problem was with the out-of-the-money credit spreads. You just never know when the price is going to come down and tangle with those strikes and perhaps create a maximum loss condition for there, which is usually something like 8 to 1, 9 to 1 reward to risk. Or should I say risk to reward on trades like that. All right, folks, that is it for today's report. Thanks for listening, and we'll see you tomorrow.